The U.S. economy is emerging from the worst financial crisis since the Great Depression. But many experts now say it's only a temporary reprieve, and we're about to face another downturn. It's called a double-dip recession, and it may be unavoidable. This week, our experts will show you the warning signs along the road to recession. We'll explore the lessons we can learn from overseas and how our economy will affect the rest of the world. But the most important lesson to learn is how to protect your money. We'll show you how to do that using strategies that include dividend-paying stocks, exchange-traded funds, and natural resources. That's all coming up right now on Money and Markets.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. Late last month, the Dow Jones Industrial Average fell back below the 10,000 mark. Now, that may be a sign that investors are finally waking up to what our first guest this week has been warning about for months now, another broad downturn in the U.S. economy. Mike Larson is the editor of the Safe Money Report for Weiss Research. Okay, Mike, what are the big red flags that are telling you that we are headed toward a double-dip recession?
Well, Jamie, the most recent sign is the June employment report that the government released early this month. It's funny, at first glance, the numbers don't look that bad. The U.S. economy did lose 125,000 jobs, but that was roughly in line with expectations. And if you discount all the temporary census workers that came off the books, you actually see there was an increase in private sector jobs. Plus, the unemployment rate fell from 9.7% to 9.5%.
Okay, Mike, then where's the problem?
Well, if you drill down a bit more into the report, you're going to see some real weakness. Let's start with the unemployment rate. The decline in unemployment really wasn't good news because it only happened as a result of the overall labor market shrinking by more than 650,000 workers. In other words, people are giving up on looking for work at all. You add those folks back in, and you see the unemployment rate would actually be just shy of 10%. And there's even worse news in the average hourly earnings numbers. They dropped by 0.1% last month when economists were expecting them to rise slightly. You know, my data goes all the way back to 2006, which was actually before the last recession started, and these numbers are the worst we've seen than at any point during the last 4 years.
Mike, we've also got some housing data recently, and those numbers look pretty dismal as well, right?
Oh, absolutely. The pending home sales, for example, were a disaster. They plunged 30% in May, which was more than double the drop economists were expecting. You now actually have pending sales that are at the lowest level since the National Association of Realtors began tracking the data almost a decade ago. Plus, that followed a similar decline in new home sales, as well as negative reports on durable goods orders, consumer confidence, and frankly, a host of other indicators.
So all these readings then are telling you that we are headed back into a recession.
Jamie, there are warning signs everywhere. It's just a matter of paying attention to them. And more importantly, it's not just the backwards-looking economic reports either. There's one indicator that actually looks towards the future that I like to follow, and it's called the Economic Cycle Research Institute's Weekly Leading Index. I know it's a mouthful, but again, this is a forward-looking indicator. And it's been falling steadily since it hit positive 28.5 last October. As a matter of fact, last month it fell to negative 7.7%, which was the worst reading in more than a year. You know, the last time this ECRI index was this low, recession struck within just a few months.
Mike, you're convinced then this is not just a risk of a double-dip recession, but this is a reality.
That's right. And the bigger picture is important here. Despite the largest economic stimulus package in U.S. history, despite near 0% interest rates, despite the biggest bank bailouts on record, the economy is still sinking again. So you have two choices from where I sit. You can sit idly by, take a beating in the markets, and lose a boatload of money, which I don't think anybody wants to do, or you can go on the offense. And in my Safe Money Report, I'll show you exactly how to take aggressive action that'll help you turn lemons into lemonade, protect yourself, and even profit as stocks fall. I have a three-pronged conservative strategy for surviving this double-dip recession. I believe it offers simple, common-sense solutions that anyone can follow, and that'll protect you from the coming storm. First, sharply reduce your positions in the stock market. We're already seeing some cracks start to form, and the bear market could start in earnest any day now. In fact, I think the U.S. stock indices could drop all the way down to their 2009 lows. That's below 6,500 on the Dow and 667 on the S&P 500. And if that happens, it means that virtually no investment in the stock market is safe. So don't waste your time trying to find one sector that's falling less than the others or hunt too much for relative value. My take is simple. Sell, bite the bullet, take some losses, and be thankful you got out before the real carnage started. Now that you've sold your stocks, you can implement my second strategy, raise cash. Now you might argue that with cash the return on your money is minimal, and frankly you'd be right. But in a time of crisis, you have to be focused on return of capital rather than return on capital. Now of course you might have a question which would be what to do with all that cash. I suggest moving into short-term treasuries or treasury-only money funds. You can buy treasury bills with maturities of 6 months or less from Uncle Sam himself through the Treasury Direct website. Finally, my third strategy is simple. Hedge against downside risk in any remaining stocks you own. You can do that in a couple of ways. First off, with inverse exchange traded funds, which we'll hear more about later. And secondly, you can use put options. These are investments that rise in value when the underlying stocks fall. Here's the bottom line. This market is about to crack wide open, but you don't have to suffer along with everyone else. Get your money to safety by putting this three-pronged strategy into action.
Okay, Mike, so if and when the market cracks wide open, like you say it's going to do, where will we see the most dramatic moves?
Well, I think there's three areas of the stock market that you want to stay very far away from. The first is real estate, the second is banking, and the third is retail. Now, the first we talked about a bit already, and that's the real estate market. Among the other bearish indicators, you have new home sales that are at the lowest levels on record, and that's the kind of collapse that's sure to hit the housing and construction stocks. Moreover, the homebuyer tax credit that the government had used to artificially boost the sector over the past year has now expired. So you've got another reason why real estate stocks could turn down. Frankly, I think these stocks have so much room on the downside that if you're holding them, you should run for the hills.
Well, we discussed the banking sector in a previous episode. Tell us a bit about what you think is going to happen there.
Well, as the broader economy and the labor market weaken, something's inevitable, and that's that credit quality will suffer. You'll see more and more people that are going to become delinquent and then default on all sorts of loans. Mortgages, auto loans, credit cards, all of those products, as the loan losses go up, it's going to take a serious toll on the bank's bottom lines. I also think we're likely to see maybe even another wave of collapses in the financial industry.
You've also said the consumer spending is going to take a hit, so I guess retailers, they're in the crosshairs as well, right?
Oh, exactly. We've already seen earnings warnings from several retailers, and that includes the biggest electronics retailer, Best Buy. I think we're going to see more of those earnings warnings and more companies falling short of profit targets in the coming months.
We're going to talk more about the retail sector with Nihilus Mativ in just a minute and with Ron Rowland. That's a little later in the show. Do you think the downturn is inevitable, and are there any solutions out there?
You know, I'm glad you asked. The only thing that could stop this double-dip recession from happening is if we could all climb into a time machine and go back to 2003 or 2004. If we could do that, we could nip the housing bubble in the bud. We could stop the banks from building up ridiculous leverage. We could enact more responsible Fed interest rate policy. And we could pursue better regulation. But of course, we can't do that. The way I see it, this coming recession is an unavoidable consequence of the immense bubble that we had, as well as the irresponsible bailouts the government instituted to attack it.
Okay, Mike Larson, thanks so much for being here, Mike.
Thank you, Jamie.
Well, I wish we could rely on Doc Brown and his DeLorean time machine, but we can't. The next best thing, though, to stopping the recession is protecting yourself when it does strike. And joining us with some suggestions on how to do just that is Nihilus Mativ. He's a financial analyst at Weiss Research and the editor of Dividend Superstars. Okay, Nihilus, should we just be stuffing cash into our mattresses at this point?
Well, not exactly, Jamie. I agree with Mike that another recession is coming, and you do want to limit your exposure to the stock market. But I'd tell investors to take a conservative approach and get out of cyclical plays like industrial stocks. At the same time, you always want to have a part of your portfolio allocated to stocks, and I think there are ways to stay in the equity market and still make money.
Okay, so where in the stock market should investors focus?
I would stick to defensive industries like consumer staples, utilities, and some healthcare and pharmaceutical stocks. They're companies with business models that can weather economic storms. Many of them also pay dividends, and that offers you more downside protection even during recessions. So there is a way to stay in the stock market and collect income, but still partially offset the effect of a temporary decline.
Okay, now let's dig a little deeper here into some of those suggestions. What is your #1 defensive sector for riding out a recession?
Right now in my Dividend Superstars portfolio, we're heavily weighted toward consumer staples. They make household products, alcohol, tobacco, some food and beverages, things that people don't stop consuming even during tough economic times. And so one of the stocks I've been recommending in my newsletter is Coca-Cola. Besides the fact that it's one of the most recognizable brands in the world, it sells a product that people don't trade down from even during recessions. I mean, think about it. The price difference between a premium brand like Coke and generic brand is negligible. So a company like Coke is going to maintain its sales. Plus, it has a huge international presence, particularly in Asian countries, which may not be badly affected by a slump in the US or Europe. And like all the stocks in my portfolio, it pays a healthy dividend.
Now, Alice, you also mentioned utilities. I suppose during a recession, people aren't going to stop paying their electric and gas bill, right?
Exactly. The thing I'd note, though, is not all utilities are created equally. You want to stick to utilities that operate in the more economically viable areas of the country, like New York City or Washington.